going to start by talking about the different categories of lenders that are out there in the ecosystem. And, we might take a couple of polls to also see where you are along the student life cycle. But irrespective of where you are, whether you're still trying to do maybe GRE prep, or maybe you start applying, maybe you have some admits, maybe, you're ready to go for spring 2019. It's still very important to know what the categories of lenders are, what the nuances are, what's different between them, what are the advantages, maybe some disadvantages. I'll then want to speak about some very specific education loan terms that are used by lenders. And again, different lenders use different terms, so it's important to understand very often they're talking about the same thing, but they're just using different terminology, which can confuse a lay person. And therefore, I'm just going to try and put everything on the same page so that it's easier to understand terminology. Then we'll take a very quick look at how, now that we're armed with this information of what the categories are, what the terms are, how can one actually go about comparing loan options? And suppose you're in a position where you have multiple loan offers. What does that mean for you? How do you go about deciding what's right for you? What are the tools? What are the terms? How do you make the best decision for yourself at the end of the day? So part one, the various categories of lenders. So we're going to look at the various categories. There's one page, but just to understand how it's structured, we'll read this in a clockwise order. So let's start with loan amount, right? So public sector banks, essentially government-backed banks, all will offer collateral-based loans, right? Which essentially means, yes, they're happy to lend you a certain amount, but you will invariably, you or your parents, whoever is the owner of the property, would have to put forward collateral against that loan. So the loan amount that you can get from a public sector bank is up to 90% of COA. So again, this is an acronym that we use. It's essentially cost of attendance. The cost of attendance is the sum of your tuition and living expenses for the entire period of your studies. So a public sector bank will typically lend up to 90% of cost of attendance. What that means is, in some countries, the remaining 10% is what is called margin money. Again, this is a unique term used to, in layman terms, what it means is this is money that has to be the 10% of the cost of attendance, which has to be, the borrower has to prove that they have this money upfront before they get the approval for the remainder 90%, right? So that is your own contribution towards your studies. Interest rates, again, as of now, are around the 10.5% mark, right? In some cases, some public lenders may offer a discount if you take out insurance against the loan, right? Do remember, for instance, suppose the insurance is, if you do take out this insurance, suppose they offer you a 0.5% discount, remember that you would still need to factor this discount into the overall cost of the loan, because there is a cost of taking out the insurance in the first place. And in a later stage, I will explain how you actually go about factoring in the cost of the loan to arrive at APR, annual percentage rate, how you compare loans. But for now, I think it's sufficient to know that there is an interest rate discount if you take an insurance with a public sector bank, but that also impacts the annual impact of your loan, the annual percentage rate. Loan terms. So typically, public sector banks will ask for both collateral and a cosigner. So the collateral, like I explained, is typically at least around 100% of the loan amount, or sometimes 125% of the loan amount that you're looking to borrow. And the cosigner is typically also one or both of your parents in most cases, right? So you'd also have to look at not just property. Now, my understanding is there are a lot of people in this call who are in their teens or 20s. Chances are you don't have property of your own. So it's going to be parental property, which means not only are they hypothecating that property and assigning it to the bank for the period of duration of the loan, let's say it's 10 to 15 years, but there would be, some maybe even a credit report requested from the cosigners, right? Also be aware that these loans, given the nature of public sector banks, tend to have a lot of paperwork. So just be prepared if you're going for a loan like this, that you will have to give it at least a few weeks, closer to a month or more. Make sure you have that buffer amount of time in hand, because it is going to take longer than you would anticipate. Additional benefits. So a lot of lenders out there, especially in the private space, are offering a lot of value-added benefits over and above just the loan to students, they realize that that does make an impact, on the student and the decision making. Unfortunately, at this point of time, from everything that's available in the public space, public sector banks are not yet offering any value-added benefits. That might change, but that's how we stand. So the next category is, again, what's called non-banking financial corporations, or NBFCs. We'll just, use that acronym. So these are actually private entities that don't necessarily have a full-blown banking license, but they are registered and authorized to lend, right? And now these are typically cosigner loans. So what that means is the loan amount, and again, let's read this in clockwise order. The loan amount could very well be up to a full 100% of your cost of attendance, which means, that's all you need, right? It's covering your tuition and your living expenses for the entire duration of your studies. Do remember that these loans will always require a cosigner. One, if not both your parents typically would be required to cosign on these loans. What a cosign essentially means is that makes one or both of your parents, whoever the cosigners are, equally liable to repay the loan, or if there's a default, they are equally liable for that as well, right? So the liability is actually spread across multiple people. Collateral is often required if the value of the loan is above a certain amount. Usually it's about $55,000. These policies keep changing. So you might still be required to provide collateral if you're going in for more expensive 2-year program. Interest rates, again, remember that while certain central banks may mandate a certain interest rate, since these non-banking NBFCs are not necessarily governed by central banks, they can actually come up with their own proprietary interest rates, right? Now, what happens in these cases are these interest rates, all you'll see is one rate. You will have to be vigilant to see what frequency that rate changes at, right? And keep a tab on that, because that's going to impact your loan. All education loans are variable rate loans, and we'll explain that in detail. But just keep in mind that these are proprietary rates that are set by NBFCs on their own, irrespective of any other rates which are proposed by a central bank. So what's best in your own interest, if you're getting such a loan, is to also request for the APR on that loan. And I'll explain that in detail, but in short, the APR is the annual percentage rate. There are multiple factors that could impact why your APR is higher than your interest rate. Some of them could be, especially in the case of an NBFC, they would typically charge you for the sanction letter, the loan sanction letter. Remember, these are foreign currency loans that are then being converted into the currency where you're going to study, such as USD. So there would be that charge, which is passed on to you. All this adds up to the cost of a loan, and that's reflected in the APR. So you simply have to request the lender for the APR on your loan, and that empowers you to then compare this loan with any other loan offer that you may have. Again, I'll show you an example for that. But moving on to loan terms. So loan terms, like I said, these are all cosigner loans, which means your cosigner's credit score may also be required, maybe their salary and credentials. And it's possible, if your parents are retired, this might be a little bit of a challenge on the credit score front if they don't have an income currently. And additional benefits. So yes, NBFCs are quite smart with this. They have come up with quite a plethora of additional benefits. You'll find this on their websites. It's usually around student discounts around travel and telecoms and so on and so forth. But it's a good value add for any student looking at an NBFC loan. Right. The last category of loans is international lenders, right? And just so you know, Prodigy Finance falls in this space as well. There are other international lenders. Please feel free to do your due diligence and look up all your options. These loans are typically without a cosigner and also without collateral, right? They can still cover up till your full cost of attendance, right? If you qualify for that amount, you'll get like 100% COA. These are essentially merit-based loans. So what that means is there might be certain criteria depending on the school they're applying to. It might be, for instance, in the case of Prodigy Finance, you need to have an admit from a top 100 school. So once that is through, the merit part of it is through, then the lender feels, yes, we can now lend without collateral and cosigner because that's the only model they have. So yes, there is a qualifying criteria that you need to have, be applying to and have an admit from a top-ranked school because these are merit-based loans. Interest rates, again, are customized. So again, these are not necessarily governed by a particular central bank rate, but because they're international loans, these loans typically tend to float on what is the LIBOR of the specific currency. For instance, if you get a USD loan, they will be floating on the USD 3-month LIBOR, right? So again, the 3-month LIBOR currently is 2.33%. So which means if someone, an international lender, offers you a 7% loan, so that would be 7 plus 2.33, the variable part of it, effectively a 9.33% loan. So again, this is important to know what, all loans, like I said, all education loans are floating rate loans. You got to know what the variable component of that loan is. For international lenders, it is the LIBOR, typically. And again, international lenders mandatorily have to disclose the annual percentage rate, APR. So they will all disclose it, and it helps make it a little easier for you to then compare loan offers. The loan terms, again, of course, no collateral, no cosigner. Also, they're typically 100% online. They don't require massive amount of paperwork that you might encounter typically with a public sector bank, which makes the whole process much quicker, typically a couple of weeks. It's also quite transparent. Like I said, a lot of the details are shared with you, such as annual percentage rate, the exact repayment dates. So there's a fair amount of transparency even at an early stage when you're applying. And specific to Prodigy Finance, the way the model works for terms is you're assessed on your future earnings potential. What this means is you could be a student applying straight after your BE for your MS with absolutely zero work experience and zero full-time income over your lifetime, and you might still be, and you will still be eligible for a loan because you have an admit from a top 100 school. So it's all future-based. It's looking at, never mind that you don't have an income or you're still a student, the fact that you will in 2 years, 2+ years time be graduating from a top 100 school in the US means your income will be at X level and you will be able to comfortably repay a loan. And that's how the earnings model takes into consideration the fact that you can have a no collateral, no cosigner loan. And finally, of course, additional benefits. So for those of you who didn't know, specific to Prodigy Finance gives out 11 scholarships every year of $10,000 each. Of course, it's competitive, but everyone who gets a loan from Prodigy Finance can apply. If you were to be the recipient of one of these scholarships, it's essentially waived off from your loan outstanding, which means suppose your loan outstanding was $50,000. In the very next month after you receive the scholarship, your loan outstanding will be $40,000. So that's how the loan award works. There's also career support. So there's a team that works in Prodigy Finance and partners to help you around improving your CV with reaching out to the 10,000 plus alumni that we already have across the world, and basically getting you prepared not just for your final job out of campus after 2 years, but also your summer internships. A lot of that starts soon after you arrive in the fall. Moving on, education loan terms, right? So this is again something very important to know because you will keep hearing these terms brought up, sometimes in slightly different ways. So the first one to take into consideration is what's called a fixed margin. Now, every loan will have a fixed rate part of the interest rate, right? So usually the overall interest rate in your loan is broken up into a fixed rate and a variable rate. So if Prodigy Finance, we call it fixed margin. Some other lenders, especially Indian ecosystem, they tend to call it the spread, right? Either way you look at it, this is a rate that is offered to you based on your profile, based on data that you have provided, and that has been analyzed by a credit committee and a model. And once this rate is decided, it's actually fixed, which means this rate remains the same for your entire study period, your grace period, which is usually 6 months from after classes end, and the entire repayment period, which could be right up to 20 years. So this is the fixed component of your loan. It's called the fixed margin or sometimes spread. The next thing to take into account is the variable part of interest rate. So like I said, to the best of my knowledge, every education loan out there is a variable rate loan. It has a fixed component that I just spoke of, and it also has a variable rate. Now, these rates change periodically, right? In some cases, base rates, as they're called, depend on either the geography or the currency that you're borrowing in, or sometimes on the governing authority like the central bank. So let's just take a few examples so that we're clear with what kind of terminology we might encounter. With Indian banks, this variable rate is what's called the MCLR, the marginal cost of lending rate. It's usually updated by the Reserve Bank of India periodically. As of the most recent one that we have received from public sources, it's 8.45% as of the 1st of July this year, right? So this is the variable part of the rate. If you get a loan in USD, it would typically, in most cases, float on the 3-month USD LIBOR, which, like I mentioned earlier, is 2.33%, right? For those of you, may not be too many on this call, but I'll let you know anyway. If you are looking at specific programs in the UK and applying for a loan in British pounds, the 3-month British pound LIBOR is 0.71%. And for those in the European Union, again, may not be too many on this call, the 3-month Euribor is actually currently negative. Now, no lender will apply a negative rate on your loan. What that essentially means is for the period of time that the variable rate, in this case, the Euribor is negative, it actually becomes a fixed rate loan. Just the fixed margin is taken into account, and the variable rate is essentially zero for that period. Again, I believe there's an international audience here, so quickly touching on Brazilian banks, the select rate there, which is the bank variable rate, is 6.5% as of the most recent change. So now that you have an understanding of what variable rates can look like, we can talk about annual percentage rate or APR. So I brought this up earlier as well. It's as simple as saying, now that you know your overall interest rate, does that help you compare loans if you have more than one offer? Actually not, because every loan out there has some additional costs associated with it. And therefore, the most important thing is for you to do your due diligence at your end. Approach the lender if they're not disclosing the APR on their loan. Let them know you have every right to ask for the APR. And once you have the APR, it's as simple as just comparing the APR across different loans. As long as the repayment timeline is the same, like assume a 10 or 15-year repayment, you should ideally just go with a lower APR loan. I mean, that is what any financial advisor will advise you on. But what is the process to actually arrive at the APR, right? So firstly, remember that for international lenders such as Prodigy Finance, we typically just have one additional fee, which is the administration fee on the loan, 2.5%. It's a one-time fee, 2.5% of the actual loan amount. Now, local lenders, typically in-country lenders, tend to have multiple additional fees. These might include one or more of an admin fee, similar to, it could be either a percentage or a flat amount. A loan sanction letter fee, like I said, in some cases, you might be charged up to 1% of your loan amount just for the loan sanction letter fee, which you need to, of course, show for your I-20 and visa purposes. Incidentally, there is no charge for loan sanction letter from Prodigy Finance. A fee for insurance against loan. Again, like I said, some public sector banks will offer you, let's say, a 0.5% discount if you were to take up insurance against that loan. But the fact is, they are offering the insurance. There's a cost of taking up that insurance from this bank. And you need to be able to factor that into the overall cost of the loan, the APR. Now, again, this is a rather complicated calculation attempt independently. You would probably get it wrong. And therefore, again, any financial advisor will say it's best to ask the lending entity itself, whether it's a bank or NBFC or an international lender, for the APR on the loan. Also remember, sometimes there's currency conversion fees. So if you're borrowing from an in-country based lender, you're probably getting a domestic currency loan. But the fact is, you're going off to study, let's say, in the US. So you need, all that has to be converted to USD. There will invariably be currency conversion charges. And in every case, that is passed on to the borrower. So again, this will impact your APR, your annual percentage rate, your cost of borrowing on an annual basis. So knowing that all these factors are in place, the best way to go about it, like I said, is to, if the lender, especially the domestic lender, is not disclosing the APR upfront, you as a borrower have every right to request for it. And then you are empowered, you are in the best position to literally just compare APR across different loans and go with the lowest APR. Typically, that should be over the same time frame. Then you're making an informed decision, like the same repayment period on the loan. So before I move on, a very important thing, because you will see this not just on loans, but when you move to the US, you will see APR on credit cards that you apply to. So it's a very useful tool to know how to compare credit products. It could be a loan today, it could be a US credit card tomorrow. Just remember that the APR is not your interest rate. It's typically higher than your interest rate. It's just a tool for you to compare different loans and make the best decision for yourself. And with that, talking about comparing loans, something important to keep in mind is that it is good to look beyond just APR, right? So while APR is a number, and that essentially, my understanding is I'm talking to a lot of engineers on this, potential future MS candidates. Easy to look at numbers and just say, hey, this is higher or lower, and therefore I choose one over the other. But other factors to keep in mind, just as important. One is the length of time for approval. So I said earlier, right? If you're getting towards, let's say, a spring admit, and you just have a few weeks, left, chances are a public sector bank may not be right for you because the entire process could take well over a month. Also keep disbursement timelines, in mind when you look at this. The ease of securing the letter, the sanction letter, because this is critical. That when you go for your I-20, when you submit your I-20, or especially for your visa, let's say at the US consulate or embassy, you would be required to show this letter, right? And how easy is it to get that? Will it be mailed to you? Is it just a soft copy? Is there a charge for it? These are things to consider. And the ability to make early loan repayments. So remember, at this point of time, it's possible you don't necessarily have money or your family, and therefore looking for a loan, which is fine. You should not delay your studies if you can get a loan and go ahead. That's what we believe. Having said that, it's quite possible we're talking about a multi-year period of repayment that in a future point of time, you may be in a position where you're flush with money. Maybe you got a joining bonus when you started your first job, or perhaps your family has sold some property and they have funds that they can help support you, and you may want to make a prepayment on your loan. Now, there are certain lenders out there that might restrict the number of prepayments that you can make on a loan, up to maybe 3 a year. Some of them don't allow you to repay in the first 6 months. So these are things to ask upfront and keep in mind. You don't want to be penalized for trying to reduce the interest that builds up on your own loan. Just so you know, Prodigy Finance, being an international lender, does not have any prepayment penalties. So again, keep that in mind. Over and above APR, like I said, other points. And that brings us, I'm almost wrapping up here, but based on everything I've spoken, and I think there's a lot of information that has come across, it may have seemed like a lot to absorb, which is why we thought it's useful to literally come up with a screenshot of one-stop single page where we can do a quick comparison against the categories of lenders, which you see in columns, and the different terms and the typical terminology that we have come across, which at the end of the day should help you make an informed decision. So quickly, just running through the list again, we've spoken about most of this. The loan amount, remember, with public sector banks, up to 90% of your cost of attendance. The rest is 10% margin money, which you have to provide upfront. And with NBFCs, international lenders, up to 100%. Collateral always required with public sector banks. With NBFCs, typically, if your total loan amount exceeds roughly $55,000 or the local currency equivalent, you would be required to provide collateral. International lenders never require collateral. Similarly, with the co-signer, public sector banks will always require a co-signer. So will NBFCs, one or both of your parents, typically. International lenders, again, merit-based loans, you don't require a co-signer. Interest rates, we've spoken about that. Public sector banks, 10.5%. NBFCs, this is from what's on their websites. It's a range. It's between 11.25 to 11.85. Again, remember, these are all variables, subject to change. With international lenders, this is actually a Prodigy Finance example. The fixed rate is between 5 and 8.5%. This depends on the program and the school you're applying to, as well as, of course, your own profile. About 50 parameters are taken into consideration to customize the rate for every individual and school you're applying to. And of course, this floats on the 3-month LIBOR, which is variable. So it is a variable rate, just like any other rate that you'd get with any other lender. Hidden costs, remember, public sector banks have admin fees, insurance, currency conversion fees. NBFCs typically have a sanction letter fee of 1% of the loan amount, and also currency conversion fees. With international lenders, Prodigy Finance in this example, there's one fee, it's 2.5%. It's not added to your rate, so don't get that wrong. It's 2.5% of your total loan amount. So for instance, if your loan amount is $40,000, your fee on that would be $1,000. The APR, again, is important because this is what helps you compare loans. So public sector banks, by virtue of having those additional hidden costs, would be upwards of 10.5%. Now, we've not put a number out there because we don't know how these stack up. And you shouldn't try to attempt calculating APR on your own. Just ask the bank to provide it. Similarly with NBFCs, if the interest rate starts at 11.25% and they have a sanction letter fee, currency conversion, it's going to be north of 11.25%. The exact figure is again something you should request from the lender. With Prodigy Finance, in this third example, we can be a little more specific because I'm representing the firm and I'm providing you the data. So depending on whether it's 5 or 8.5%, those two lower and upper limits, and the 3-month variable, your APR could be anything ranging from 7.83% at the very minimum to 11.53%. And this is as of today. Repayment period. So public sector banks cap out at 15 years. NBFCs is usually 10. You can request up to 12, but they don't go higher. And international lenders, including Prodigy Finance, can lend you as high or as long over a 20-year period if you wish. Typically, the loans are for 10 or 15 years, but you can, in certain cases, for very expensive 2-year programs, make a request for a 20-year repayment period as well. Prepayment penalties, none with public sector banks or international lenders for that matter. NBFCs, it gets a little tricky. Just make sure you inquire about these. As of now, you're not allowed to make repayments during the first 6 months of your loan. And even when you do start making any kind of prepayments, this is, of course, over and above your EMI repayment, you will be restricted to only 3 prepayments per year. Documentation, both public sector banks and NBFCs have a fair amount of documentation required just because they're asking for collateral or cosigner or both. With international lenders, it's fairly minimal because the requirements, it's merit-based, right? So they need to, of course, see your admit letter and a credit report of your own. And of course, it's all soft copies because it's 100% online model, which means the typical time to get a loan from an international lender or an NBFC, which they're quite nimble, is usually around 2 weeks. But like I said, keep in mind, if you're going with a public sector bank, it could be a month or even longer. So just make sure you're not scrambling at the end. You would have to keep that in mind, the timeline. Value-added benefits, I think we've spoken about this, none as of today from banks, but NBFCs give student discounts, and international lenders, specifically Prodigy Finance, gives scholarships, career support, besides student discounts.